Hey guys, this is Kritesh and welcome to TradeBen's YouTube channel. In this video, we are going to discuss mutual fund taxation, that is how mutual fund returns are taxed in India. First of all, if you are new to this channel, please subscribe. We publish new interesting investing videos every week. Mutual fund taxation in India depends on the type of fund and the holding period of your investments. In order to clearly understand the mutual fund taxation, first you will need to learn common types of mutual fund, and then you will need to understand how short-term and long-term investments are defined based on the holding periods of mutual funds. Let's start with types of mutual fund. Although there are dozens of types of mutual funds in India, however, here is a broad classification based on the asset type and fund characteristics. First, equity funds. These are the funds that invest in equities, that is the shares of a company, which can be actively or passively managed. These funds allows the investors to buy stocks in bulk with more ease than they could purchase individual securities. Equity funds have different key goals like capital appreciation, regular income, etc. The second type is debt funds. These are those funds that invest in debt instruments, that is fixed return instruments like bonds, government securities, etc. Debt funds have low risk compared to equity funds. However, the expected returns while investing in debt funds are also lower. The third type is balanced fund. A fund that invests in both equities, that is shares, and debt instruments like bonds, government securities, etc. is known as balanced fund. These are also sometimes called as hybrid funds. The next is SIP, that is systematic investment plan. SIP refers to a periodic investment in mutual fund. For example, the investor can make a fixed amount, say rupees 1000 or rupees 5000 every month or every quarter or 6 months to purchase some units of a fund. SIP helps in investing automation and brings discipline in investment strategy. And the fifth one is ELSS. It stands for Equity Linked Saving Scheme. ELSS is Diversified Equity Mutual Fund with a tax benefit under Section 80C of Income Tax Act. The maximum tax exemption limit is Rs 1.5 lakhs per annum. However, to avail the tax benefit, your money must be locked for at least 3 years. Now that we have understood the different types of mutual funds, let's define what is short-term and long-term with respect to mutual fund investments. In case of equity-based mutual funds and balanced funds, if the holding period is less than 12 months, then it is considered as a short-term investment. Further, if the holding period is more than 12 months, it is considered as long-term investment. Here, holding period is the difference between your purchase date and the selling date. For the case of debt-based mutual fund, an investment with holding period less than 36 months, that is 3 years, is regarded as short-term investment. On the other hand, a holding period greater than 36 months for debt funds are considered as long-term investment. So here is a quick summary of the short-term and long-term investment classification on mutual funds based on the holding periods. So now that we have understood both the types of mutual fund and the holding period, let's move forward to define how mutual fund returns are taxed in India. As already mentioned earlier, the mutual fund taxation depends on the types of fund and the holding period. Here is the rate of taxation on different mutual funds in India. First, equity-based mutual funds. The long-term capital gain tax on equity-based mutual fund is tax-free up to a profit of Rs 1 lakh. However, for the profits above Rs 1 lakh, you have to pay a tax at a rate of 10% on the additional capital gains. On the other hand, for the short-term equity-based mutual funds where the holding period is less than 12 months, you have to pay a flat tax of 15% on your profits. Clearly, long-term is a better choice as there is no tax up to a capital gain of Rs 1 lakh. For an average Indian investor, Rs 1 lakh profit is a big amount. Let's understand it better with the help of example. If you invest Rs 5 lakh in mutual funds and get a decent return of 20% and make a profit up to Rs 1 lakh, this profit will be tax free. You do not need to pay any tax on the long-term capital gain up to Rs 1 lakh. In the second case, let's assume that your profit is Rs 1 lakh 10,000 in long term. Here you have to pay a tax of 10% on the profit greater than 1 lakh, that is Rs 10,000. In short, you have to pay a 10% long-term capital gain on Rs 10,000. In the third case, let's assume that you bought a mutual fund and sell it within 12 months. So here you have to pay a short-term capital gain tax of 15% on your profits. The second is debt-based mutual funds. For the debt-based mutual funds, the long-term capital gain is equal to 20% after indexation. Please note that indexation is a method of reducing the capital gains by factoring the rise in inflation between the years the fund was bought and the year when they are sold. The longer the holding period, the higher are the benefits of indexation. Overall, indexation helps you to save tax on gains from debt mutual funds and enhance your earnings. For the short-term capital gains on debt funds, when the holding period is less than 36 months, the profit will be added to your income and is subjected to taxation as per your income slab. Therefore, if you are in the highest income tax slab, you have to pay a tax up to 30%. The third types of mutual fund is tax saving equity funds, that is ELSS, equity linked savings schemes. ELSS is used for tax saving along with capital appreciation. It is an efficient tax saving instrument under Section 80C of Income Tax Act of 1961. You can claim a tax deduction of up to Rs 1.5 lakh. However, there is a lock-in period of 3 years for these funds. After 3 years, long-term capital gain tax will be applicable similar to the equity funds. Therefore, a capital gain up to Rs 1 lakh is tax-free, but profits above Rs 1 lakh is taxable at a rate of 10%. Now let's move forward to the balanced or hybrid funds. Balanced funds are treated similar to the equity-based mutual funds and hence have the same mutual fund taxation structure. This is because balanced funds invest at least 65% of its assets in equities. This allocation percentage can differ depending on the goal of the fund and the decisions by the fund manager. The long-term capital gain tax on balanced mutual fund is tax-free up to gain of Rs 1 lakh. The profit above Rs 1 lakh is taxed at a rate of 10%. The short-term capital gain tax on the balanced fund is equal to 15% of the profits. Finally, let's discuss the taxation on SIPs, that is systematic investment plans. You can start a SIP with either an equity fund, debt fund or balanced funds. The gains made from SIPs are taxed as per as the type of the mutual fund and holding period. Here, each SIP is treated as a fresh investment and they are taxed separately. For example, if you are investing monthly of Rs 5,000 in equity funds, then all the monthly investments will be considered as a separate investment. This simplifies the holding period. Assume you bought your first SIP in January 2017 and consequently SIPs in the upcoming months. Then by the end of January 2018, only the first investment will be considered as a long-term investment. The other investment is for a period of lower than 12 months and hence they have to pay a short-term capital gain tax on the rest SIPs if you redeemed all of them in January 2018. In short, each SIP is considered as a separate investment and their holding periods are calculated accordingly to define the taxation. So let's quickly conclude what we discussed in this video. Here is a summary of mutual fund taxation in India. So the secret to save taxes and build wealth is still the same. Invest for the long term. In most of the equity based funds, you can enjoy a tax exemption up to a profit of Rs 1 lakh when you invest for the long term. Overall, if you want to save more taxes, invest longer. That's all for this video. I hope it was useful to you. If you have any doubts, comment below in the comment section. I will be happy to help you out. And if you like this video, please hit the like button and subscribe to this channel for more interesting investing videos. This is Kritesh signing off.